partnership. If you have any questions during the webinar, you can submit them in the panel on the right-hand side and we will answer them after the session. CPD certificate, slides and any other notes will be emailed to you after the webinar, and I'll now hand you over to Jeremy Martin. Hi Jeremy, are you still there?
Yeah, well, I'm there.
We've started the webinar now if you want to start the presentation.
Okay, good morning everybody. My name is Jeremy Martin from Partnership. Welcome to today's session entitled Retirement Rules and Ramifications. And heaven knows over recent times there's been an awful lot of rules and changes that we've had to deal with, which is exciting but also challenging and presents a lot of opportunities for us and as a community for our clients as we go forward. Today, what we're going to seek to cover is these learning objectives in terms of having a look at sharing the detail around the new style drawdown. We'll have a look at some of the implications, the new ways of taking lump sums, look at some of the changes to the annual allowances from 2015. Actually, that's going to be split into two parts, a sort of a recap and then a summer budget sort of update. We'll have a look at some of the new annuity options and any sort of tax planning opportunities and indeed tripwires that will come through. So as I say, the sort of final section at the back end of this, we'll have a look at some of the updates from the summer budget. As you can appreciate, there's an awful lot of stuff. This is a bit of a sort of information download, but hopefully we'll get through this. I anticipate about 40 minutes for this particular session. So, at the end of the day, freedom of choice, it is without question great news for individuals in this, because obviously freedom of choice is fantastic for people to make the decisions that are relevant to themselves. However, freedom of choice also begins or even brings responsibilities to those people, and perhaps they might not have the necessary knowledge to deal with this to make sure they get the best outcome. Pension-wise is, after all, only guidance, and it doesn't necessarily cover the sort of full ramifications of taxation changes, legislation, product design, and income sustainability. Indeed, one of the recent investigations by which looked at the pension-wise as a mystery shopping exercise, and their outcomes were, and I quote, unlikely to be in a position to make a decision for clients, and it was in fact heavily scripted. It's obviously under the spotlight of government as well at the moment, and indeed very recently we've had the change or the aspiration of change from moving the responsibility for pension-wise from the Treasury to the WP. So that's a kind of update in that particular area. As I say, this session is a bit of an information download. Some of this will doubtless be a recap for you. Forgive me if that is the case, but really I just want to make sure that everybody's singing from the same page as we step into the final section, which is the summer budget updates. So without further ado, let's just move along. This is where we were. This is the sort of pensions and makeover where we were, everything that we knew and were comfortable with in terms of trivial commutation, small pots, cap drawdown, all those bits and pieces that were there alive and kicking. We knew them very well. Followed by the situation that we now have in terms of what's gone on. And on face value, you look at it and go, well, okay, exactly what has changed here. But there have been a number of substantial changes, significant changes. Trivial commutation is still available for DB, for example, when you can use a minimum or below £30,000. Small pots is an interesting one because that moved, as we know, from 2 times £2,000 up to 3 times £10,000 for DC. But of course, for the DB environment, there's no limit to the number of times that this can be used. There are also opportunities abounded within that, which I'll touch on later in terms of UFPLS, where you could actually use or access money via UFPLS and use small pots as the designating vehicle for that. So it has some interesting ramifications because you hang on to your 40,000 annual allowance under that basis. So more of which and none. And then, of course, we've got death benefit changes that I'm sure we're all familiar with, and exclamation mark annual allowances. And as I say, we've got sort of 2 bites of that particular cherry. So let's have a look at some of these particular changes, remind ourselves of these. Flexi Access Drawdown now applies to all new drawdown crystallizations. As I'm sure we're aware, we've no longer got capped and uncapped as part of our universe, except for those capped drawdown products that were already in play. Existing flexible drawdown was converted or automatically converted to Flexi Access Drawdown. Clearly, those people that had their minimum income requirements of either £20,000 or £12,000 were already in place. But one of the big significant changes there, of course, now is that there is a MPA, money purchase annual allowance, of £10,000 that is now available. Pension can either be income withdrawal or short-term annuity, and then of course in that we also have to consider fixed-term annuity, because that as was a capped drawdown contract. There is no limit, no caps, no limits is the mantra in terms of the amount drawn from the fund each year. Therein lies the flexibility. The question I guess we have to ask here is, you can have the money, but how much tax do you actually want to pay? And this obviously begs the opportunity for planning to minimise that particular aspect to suit the client's circumstances. Amounts over 25% subject to a marginal rate of tax. As I say, the quid pro quo of this is for those that were in Flexi Drawdown and have moved across, they now have a money purchase annual allowance, whereas they didn't have one before. So what we've got to consider here is some of the tripwires, and I suppose as an observation here, some of the extreme media reporting has either sort of gone down or is polarized with a small p, the issue here in terms of annuity or cash in, and offering sort of examples like buy-to-let or opportunity to purchase cars, or indeed some of the sensible ones being just go ahead and buy some premium bonds. And we've seen some, as I'm sure you're all aware, some sensationalism around all of this. The interesting thing, though, is that some recent research from the International Longevity Centre that came out in January of this year was asking the question of the public about their level of knowledge, how much they knew certain financial products well or quite well, and it made some interesting reading. Only 33% understood what a joint life annuity was. Only 20% understood what an enhanced annuity was, and just as importantly, only 35% understood what drawdown was. So clearly, in UK PLC, in terms of retirement product knowledge, there is a big education opportunity for us all to be involved with. We will now sort of have a look at some of the tripwires, and one of the things I've already mentioned is to do with taxation, and we'll take a couple of examples here to look at this. As ever with these things, they're slightly contrived, but hopefully they will serve a purpose to highlight some points and bring things into focus for us. So we have a look at this particular example here. Here we have Les is considering buying a car for pre-retirement, and also look at the opportunities available to him to access his PCLS at age 55. As you can see, as you run those particular numbers down, his existing income in this case is £60,000. We've decided not to involve anything exciting like dividends or anything like that, so his personal allowance is fairly straightforward, £10,600, not the one from the other. We've got a taxable income of 49,400, drop out the tax bands, and there we have, hey presto, the 13,403 as a taxable amount. Nothing earth-shattering, nothing outrageous in that particular situation. The interesting point now comes where Les decides he actually wants to buy a car for £22,000 from the PCLS of his pension fund, and also take the income that goes with it. I guess one of my other observations here is that there is, again, a bit of a perception issue out there at the moment in terms of, for example, pension-wise would seem to always use the phrase lump sum. And it might, for some people, they assume that a lump sum actually means tax-free, which of course we all know that's not necessarily the case. So with that in mind, let's progress this particular example and see what some of the issues and some of the points that would come out of it would be. We have our existing income at £60,000. We've got a pension pot of £88,000, I beg your pardon, of which we're taking the 25% tax-free cash. So thereby we've got £66,000 to add into the equation here. We have a taxable income there of £126,000, and then we take off the personal allowance. No, we don't take off, because obviously, as I'm sure you're all very well aware, once you get above £100,000, there is a reduction to that, and by the time you get over 121,000 and a bit, you've basically lost your personal allowance. So we need to strike that one out of our conversation here and consider the total taxable income at £126,000. Drop out the relevant tax bands, and hey presto, we now have a taxable element here at £44,043. That's the tax to pay. Is the client necessarily happy with that? Have they got aims and ambitions for that money? Obviously, you would be privy to that particular conversation. Interestingly enough, that additional tax of £30,000, £30,640, is somewhere in the region of 46.5% of their £66,000 pension. And when it's put in those sort of terms, would that be a particularly comfortable outcome for our client situation? As I say, that is a conversation to be had. The other thing that we need to consider here, of course, is what is the effect on any means-tested benefits that might be going on as part of this pensions access exercise. If we now consider and say, well, okay, what would be the situation if the individual was no longer earning? Just again, for the sake of simplicity, we just want to explore a couple of things here. So we'll take the income from earnings out of this particular situation and just look at the pension on its own for the moment. As I say, we've got this £88,000 pot. Pension income after the PCLS is £66,000, of which we then obviously have to knock off the personal allowance, giving us £55,400. The tax bands as illustrated there on your screens, and the taxable amount has now moved in this particular case to £15,803. But of course, that's a neat example, or if I can rephrase it another way, that's the circumstance, given nothing else changing, that would happen at the end of the year once the sort of tax mitigation exercise has happened. But of course, we're all aware now that is not necessarily the case, or not necessarily the outcome as people progress through these freedom and choice access opportunities. Because we had a couple of bulletins to the provider community in terms of actually how to handle these pension accesses. HMRC 67 and indeed HMRC 68. 67 came out in February and 68 came out just at the end of March before everything sort of kicked off. And these were the instructions that were issued to the providing community in terms of actually how to handle people accessing the money from a tax point of view. And I'm sure some of you would have bumped into these particular issues. The key point there is in that box that we've highlighted, is the operates on a code on a month one basis. So what would that mean in our particular circumstances here? Let's have a quick look. So to remind you, we've got our £66,000, less the monthly allowance now is £883. Total taxable income is now 65,117, and the tax bands that we need to take off have also been severely reduced. Effectively, what is going on here is you're only getting a 1/12 of the personal allowance and a 1/12 of the tax bands being applied accordingly. So you very quickly head up the tax scale in terms of what is going to be paid. I suppose the easiest way of translating that into my sort of language is the revenues considering your clients on an income, in this case, of £66,000 per month. Not quite Premier League football standards, but certainly a handsome sum to be considering. However, that effectively would mean, in this particular example, that our client has a tax bill of £28,148, some £12,345 more than we started out, or what would be the year-end figure. It doesn't have to stay that way. There are ways and means of actually dealing with that. As I say, the bulletins, the 67 and 68, offered guidance on how this could actually be claimed back quite quickly, and they offered a number of different forms in order to do so. A P50Z, a P53Z, and a P55, and depending upon your circumstances, depending on which form that your client would have to use. And again, I would refer you to the bulletin number 68 that gives you a little bit of guidance on how that is used, again with some examples that they've got in there. A little word of, I guess, experience that we've picked up as we've travelled around the country with this is that the P55 initially, when it came out, was causing some sort of grief and controversy, because the wording of it was basically saying you could only use that form for a one-off withdrawal. But actually, in reality, you could use that form for more than one withdrawal in a year, and in the words of the Revenue, they conceded that it was poorly worded. So hopefully at the next reprint, and in fact they have actually amended that particular form. That's a bit of an aside. The other thing I'd just like to mention here, if I may, is that there was initially some confusion in terms of terminology between phrases like a temporary rate and an emergency rate, which is absolutely not the same as an emergency tax code, and there was some sort of unfortunate interchangeability that might have gone on with that. Interestingly enough, within that basis, then you had a situation where the HMRC could be quoted as saying for most people taking withdrawal may be due some sort of tax refund, and of course if those figures were less than £3,000, that would probably be returned via the tax code. So I guess in these particular circumstances, and we've heard all sorts of anecdotal stories of companies telling HMRC how it should be done, so on and so forth, and I'm sure some of you have had your own experience of this. But it might be worth considering from a client retirement perspective that you might want to set up a regular income stream before you start considering lump sums, so that you actually establish a tax code to which you can then apply that particular code to any lump sums that your clients may wish to access. So that's one of our tripwires, if you like. Let's move on to another area of update or reminder, depending. I'm going to call this annual allowances part 1. Just as a reminder, some of the trigger points that we have here to reduce the annual allowance for that new concept, which was the money purchase annual allowance. So here we go. Receiving income from Flexi Access drawdown will trigger a reduction. Notice receiving income, so there's absolutely no problem with you taking or your clients taking the PCLS. If they don't take any income at all, not £1, then their annual allowance is not affected in this particular set of circumstances. Receiving an uncrystallised funds pension lump sum is another one. We will explore that in a moment. Exceeding the capped rate of drawdown on existing capped drawdown contracts. As I'm sure you're all aware, capped drawdown continues, although new capped drawdowns were no longer available. So those that have them, as long as they stay under the 150% of GAD at their reviews, then they can happily continue with that particular basis, and in doing so hang on to the 40,000 annual allowance. A couple of other ones for you here. Scheme pension, where arrangement is providing scheme pension to less than 12 members, including dependents. I suppose in old money we might call that something like a SAS, small self-administered scheme. And one other one, receiving a standalone lump sum with primary protection, which is greater than £375,000 for those lucky enough to be in that position. Both of those also trigger the £10,000 money purchase annual allowance issue. We're not quite finished yet. Annual allowance is a little bit more here. The current annual allowance of 40,000 remains for existing cap drawdowns, as I've said, and obviously designating any new tranches within those income limits. I'm sure that I don't particularly need to give you some sort of word of warning here that it depends. You do have a look at the type of contract some of your clients may have, or perhaps new clients coming to you with these older contracts, because it depended on the provider how they actually went through the mechanics of those contracts. Some of those contracts would have new tranches designated actually by a new drawdown contract. That was their mechanism, and in doing so, obviously that would take your client into the new Flexi Access drawdown world, perhaps not an outcome they want to pursue. Annuity-only clients are not impacted, assuming that their annuity is not decreasing, and for DB there is an interrelationship between hanging on to your £40,000 between the 30,000 and the 10,000 for DC. Now today that is not a conversation that we're going to open up. We can do so at another time, I'm sure, the interaction between those two particular figures. So, having done that little bit of recap, let's just sort of roll our sleeves up and have a look at some particular situations here. If we've got some clients called Jeff and Anne who want to clear their interest-only mortgage with a lump sum of £10,000, what is the most efficient way they might do that? There's a number of different ways. They want to clear that bit of mortgage. And I suppose the question we might ask here is when is a lump sum not a lump sum? And frankly, it's when it's an income. Let me explain that one. We're talking here, of course, or considering the aspect that is uncrystallised funds pension lump sum. As a reminder, it's payable from age 55 or upon ill health conditions. 25% of it is available tax-free. The remainder is taxable as pension income. No choice about this. You have to actually take the two aspects of this, unlike a drawdown, of course. There is a reduced annual allowance unless, of course, you take this under a small pots allowance. So you could actually designate, as I said previously, some UFPLS. If you designate it under small pots, then you will get around the issue of the money purchase annual allowance. It's not available. UFPLS is not available for those with primary and/or enhanced protection with lump sum rights in excess of 375,000. Why? Because under those particular protection issues, you had to access your money as a one and done basis, and therefore it doesn't sit with UFPLS. And it's not available for DB circumstances. So let's just explore that a little bit again, to see if we can highlight any issues that might potentially become a tripwire for our clients, Jeff and Anne here. Remember, they want to clear £10,000, clear their mortgage by accessing £10,000. How might they do it? Do they want a lump sum or do they want an income? If we have our pension pot here, you could say, well, okay, I'm going to head down the UFPLS route, and by doing so, I actually want to clear this mortgage, and it would split down as £2,500 tax-free, and then obviously the bit highlighted in green there, the £7,500, is taxable. And in doing so, as I previously said, the annual allowance would be £10,000. Or you could say, do you know what, I'm going to have access this under Flexi Access drawdown, and in doing so I'm going to crystallise £40,000, and in this particular example I'm just going to take the 25% of that as tax-free cash, and I don't want any income. I don't need it at this particular moment. It's just a crystallised pot. It can just sit there to a point where I might need it later on. And in doing so, you do hang on to your annual allowance of £40,000, which is right. Depends upon the circumstances of your client and obviously the discussions that you would have for that. So some of the initial unfortunate news and noise around UFPLS was looking at it as some sort of bank account access. You can just take your card and go to the hole in the wall. I mean, I would venture to suggest that is clearly not the case, because obviously there are significant tax implications in so doing. How do we know how much we're going to take out of UFPLS to satisfy this particular circumstance? Well, here's an example, and in fact, having just done the R08 exam, I can categorically say there were a number of these sort of questions that came up for me when I did the exam. Obviously, exams are always individual, so there's no guarantee it'll come up for anybody else. So if we wanted, in this particular case, to remind you that we've got £10,000 we need to actually access, how much do we need to take from the pension pot to do so? Here's one particular way of working that out. So we know that whatever money that we take, 25% of it will get the whole lot, so that's 100%. So funnily enough, that equals 25%. The balance of that money, and by the way, everybody, we've assumed a basic rate taxpayer for this example. So the balancing figure there is 75%. We're only going to receive 80% of that. So that nets down to 60%. The overall rate in inverted commas is therefore 85%. But the one over there, our required amount, which is £10,000, and here we go, we need to actually crystallise £11,765 under UFPLS to achieve our objective of £10,000 net. Obviously, we can begin to see why that's not necessarily going to look very tidy if somebody wanted to go to the hole in the wall to do it. It's not necessarily the prescribed way of doing it on the CII R08 manual, but nevertheless it works, and do have a look at that at your leisure. Incidentally, the slides will be available for everybody at the end of this. You just have to put that on your feedback, and again along with CPD as well. So if you wanted to work with those figures back, just check that we've done our sums correctly. The client needs approximately £10,000. We've got 11,765 crystallised. So 25% of that represents 2,941, and the balance is a net figure of net of 8,824 with a little bit of rounding at 0.8 gives you 7,059. Hey, press it down at the bottom. We've got our £10,000. Hopefully that's give you an idea of the whole issue of UFPLS, and then we can now move on and have a look at what's going on in the world of the good old annuity, because obviously that's dear to our hearts, but it's just part of the whole retirement journey conversation, I'm sure. There were some changes, some very significant changes that came into force here. The annual rate of income will be allowed to go down as well as up. One of the critiques of annuities was that some of their inflexibility, so hopefully that sort of removes some of those particular barriers there. You hang on to your 40,000 annual allowance if it's only an annuity, assuming that you've got no decreases going on. And when they're talking about decreases, they're not necessarily talking about contractual issues like RPI-linked annuities, for example. It's specific decreases that you might want to put in place. You can allow lump sums to be taken as long as you specify them at outset. So, for example, if you know 3 years down the line that you need a significant amount of money, you could set your income stream at the beginning, and it might be something like, I don't know, 5,000, a jump to 10,000, and then back to 5,000, whatever it happens to be to suit the particular circumstances that your client has identified. There is, of course, now no limit on the maximum guarantee period that can be offered. The nation of Chile, their most common guarantee period is 20 years. Indeed, Partnership has extended its contract now to offer 20-year guarantees. Some of my competitors, and there are people offering different guarantee periods, even up to 30 years or whatever. I would like to say from our perspective, our longevity expectations quite often, the average, and I appreciate that's a dangerous word, tends to be of a longevity expectation of 16 to 17 years. So if you start offering guarantees beyond 20, then obviously it might do some interesting things to the rate on offer. And then the final point is the commutation is back with us for guarantee payments on death if the figure is under £30,000. Which offers another conversation with the client in terms of, is it better to have the lump sum now or actually to continue with the income stream? Again, obviously that's a pertinent point and conversation with the client. Whilst we're talking on death benefits, we had some changes that have come through. We had some interim issues to deal with, but now we have the final situation now under this new system. A sort of before and after, death before or death after age 75 is the watershed year. Interestingly enough, across the UK, 80% of the UK population dies beyond age 75, but it does offer some great opportunities for wealth cascade when we start to consider some of the other bits and pieces in a moment. One of the other things that I just wanted to make sure everybody's comfortable with is that from the announcement when it came out in the autumn budget, which was bizarrely in December, you might have thought that drawdown had got a significant advantage here from a death benefit perspective, but as the information came out through that particular day, it became clear that there is a parity between drawdown and annuity, particularly if you're considering value protection as part of your annuity protection, if that's the conversation that is going on with the client. So it just makes a level playing field, if you like. So let's just explore that particular opportunity a little bit further. Jeff and Anne, in this particular case, have children aged 21 and 22. Can they leave pension income for them? Well, the answer is yes. And in this particular circumstance, at that particular moment in time, they would actually be considered financial dependents. What about when they pass the age of 23? What would happen then? Could we help them in this particular process? Well, clearly the answer is yes to that, and we'll explore a couple of the things here. There is some new terminology. I did say it was a bit of an information download that we're going to have this morning just to get you going on a Friday. We're very familiar with the definition that is dependent, spouse, civil partner, age, child age under 23, so on and so forth, someone financially dependent. But then we get a little bit of new information to deal with here. A nominee is a new definition. Anyone nominated by the member to receive an income on the member's death. Interesting enough, the scheme administrator cannot normally nominate, appoint a nominee or change the nominee. So there was, if you recall, some question as to whether that restricted the flexibility and discretion here and thereby impacted on HT, but as you will see, that's not the case. And then a final one that we have to consider here is a successor. Anyone nominated by the dependent nominee or successor to receive any remaining benefits on their death. So clearly you can see some opportunities here for wealth cascade of the pension pot if there's any available through from the starting point. Let's have a quick look at that. If we have dependents and nominees, this is a very quick look at this particular aspect here. We have our pension fund. Trustees have the discretion of how that actually might be handled, and I'm sure some of the providers now have already got nominee forms out or available for you. Options for the financial dependents, you could either have lump sum outside the pension or the pension income. And then on the other side of this coin, for non-financial dependents, you have a lump sum or the new bit, which is the pension income. And let's just have a quick look on that sort of right-hand side of the screen, if you like. And what we've got here are some options either on the lump sum or on the pension income. From the lump sum, the scheme administrator trustee still has discretion to pay to anyone within the class of beneficiary. Therein lies the discretion and the flexibility that removes the IHT issue potentially from them. From the pension income side of this story, should be nominated by the member. The scheme administrator cannot make a nomination if you have a living dependent or there is an existing nomination by a member, but they could still pay to a financial dependent. So as you can see, lots of opportunity for flexibility still abounds within the death benefit basis. That, of course, begs the question in terms of wherein do we go in terms of bypass trusts. Well, this is a very brief look at this particular area, but as you'll see very shortly, there's no particular clean answer here. As a reminder, benefits via a trust, taxed is either 0 or 45% or trustee rate, depending on the date of death. Trust monies obviously are outside of the estate, and you can take loans to a spouse to create further debt against the state. The original member establishes that future beneficiaries. Compare and contrast in the good old way of school exam questions that we used to have. Benefits from a pension fund. Spouse can only take takes only what is necessary, and the tax position is dependent upon the marginal depending upon the date of death, particularly when we're considering obviously the new post-75 criteria. The remainder stays outside of the estate, and the spouse nominates the cascading benefit. So effectively what you've got here is a situation of control. It is about who wants to have that control and how you actually want to manage that particular issue. It could be a case where you have, I suppose, what you might call blended families or situations where people have moved on and two families have become joined to one. How do you actually want to handle the pension pot from the starting point? There's no absolute right or wrong way. That's certainly not what I'm trying to suggest here. But it might be worth considering reviewing the arrangements as a 75th birthday approaches and consider whether trustees' rates versus marginal rate, which one is potentially the lower of the two, and deal with it accordingly for that. Final section before we have a look at the summer budget is to do with the impact on defined benefits. Very, very briefly here. Some of the safeguards and some of the issues, there's a lot of correspondence, a lot of legislation around here. The individual must take advice before a transfer can be accepted. That advice must come from a recognised pension transfer specialist, somebody with G60, AF3, so on and so forth, independent from the DB scheme, unless the figure is under £30,000, of course. There's a lot of correspondence, a lot of noise. I was recently at a NAPF meeting where the conversations of the trustees were about how they actually access and help people realise their pensions ambitions, and clearly there are potential for a lot of delays within the system as these issues get sorted out, and very importantly some scheme funding issues, because if you've now got access, then how do we do investment planning long into the future? And what happens there. So a lot for the trustees to be thinking about there. And notwithstanding that, the FCA handbook still says with defined benefit transfers, a firm should start by assuming that a transfer or opt-out will not be suitable. But obviously we need to keep that in mind with people wanting to access that money. Remember, it's a permissive legislation, so trustees do have an option as to how much they have to offer in terms of flexibility, freedom and choice. Some of the further guidance that was available here is to make sure that it's not the trustee's role to second guess the member's individual circumstances, nor to prevent the member from making decisions which the trustee might consider inappropriate in the member's circumstances. And you've seen some cases come around where rulings have been made one way or the other on this. They do, however, expect the trustees to conduct proper due diligence on the receiving scheme, because obviously we don't want anybody to end up in, I don't know, just pick an example, parking schemes in the Middle East or whatever it happens to be, and we've seen some of those examples hit the television of recent times. One final point in this particular area, in terms of underwriting, clearly if we have a situation where the DB schemes are having to look at their investment strategies, they've also got an issue where if you've got a population within the scheme weighted towards retirees, those already retired, if you've also got access now or increased access for deferred members, that's only going to accelerate the or swing the bias in terms of an increasingly aged DB scheme, a retired population, with all that goes with that. Remember, because freedom of choice confirms that individual retirees cannot transfer out of the DB schemes. However, if you've got all those increasing pressures on the DB schemes, we need to be able to offer to help those if at all possible, if you come across these, and they can do so by de-risking those schemes by technical provisions, by effectively buy-ins or buyouts, and for if you have any finance directors, that I'm sure they would welcome you with open arms, because your average cost saving could be in the region, in our experience, of around about 10% savings. So any finance director is going to be quite happily wanting to talk on those particular basis. As I say, it is a huge opportunity. We can help. Do give us contact us on that basis. Finally, we get to the last section with what's going on, an update in terms of the budget and indeed the green paper. Very quickly, we'll have a look at some of the bits on here. More changes to pensions, as if we haven't seen enough, but it keeps us all on our toes. We'll have a look at annual allowance, look at tax years and some transitional rules, I beg your pardon. The new tapered relief for high earners that's coming in, lifetime allowance and the consultation paper, all going on at the moment. Okay, PIPs, let's just have a quick look at that. Pension input periods, some new rules that have come into force on this. All pension input periods that were open up until the 8th of July will cease at that particular point, 8th of July. All existing arrangements, therefore, you might have 2 or 3 pension input periods ending in 2015/16. New PIPs will start on the 9th of July and end on the 5th of April, because they're aligning PIPs now to the tax years, and it includes DB schemes. It's no longer possible to vary PIPs And all of this is part of the interlinked with some new changes and some new issues that the government is looking at. And they may indeed remove PIPs as a concept altogether later on. So how might that work? This is a very simplified example. The guidance notes that came out for this on, in fact, I'm looking at them published from the 8th of July 2015. It's quite a read, so hopefully this will give you a little bit of an insight as to what's going on. Let us consider here somebody that has a PIP running, and it was due to finish on the 10th of September. Then we had the summer budget announcement, and basically what's happened is that PIP has now been closed as of the 8th of July. And therefore the date has been moved back to that particular point as the graphic which is showing you. It could include other PIPs that closed before that and any new PIPs that you had in your normal planning process that were going to go on beyond that particular point. So that is now called a pre-alignment period, anything up to the 8th of July 2015. The period from that point till the 5th of April 2016 is now called the post-alignment period. Pre-alignment and post-alignment. And there is an overall annual allowance here of £80,000 plus carry forward that we obviously know well from the previous 3 years. Hopefully you're all with me so far. There is, however, another criteria that says the max annual allowance from the 8th of July through to the 5th of April will be £40,000. And there are a number of examples in the HMRC booklet as to how that actually, or the technical sheets, how that actually would work. Suffice to say that overall £40,000 in the post-alignment period is the ceiling for that. So if you have a client that comes to you and they haven't actually been putting any pensions in prior to that point, they've only got £40,000, not the £80,000 that you can see on the line above. That £80,000 is a consideration obviously for people that were doing their normal tax planning and pension planning before the summer budget. So it allows for hopefully people coming into line with that, and there are some examples I would point you to from the HMRC document on that. Furthermore, just to add to the situation, we've got what I'm calling annual allowance part 2. We have a tapered annual allowance coming in from April 2016 for individuals with adjusted incomes. I really ought to put that in inverted commas, over £150,000, and it includes pension contributions, employer and employee ones, sort of net paid type arrangements, but it doesn't include your standard personal pension plans for that. As you can see there is a reduction of £1 for every £2 of adjusted income over £150,000, and there is a threshold income, or a net income as it's defined, is £110,000. If you're below that figure, you hang on to your £40,000 annual allowance. The floor for this is £40,000 minimum annual allowance. And it's all to do with changes to tax relief for hire owners to fund the changes on IHT allowances that were announced in the summer budget. What will it look like? It will look something like that. So if you have a client with adjusted income, by the time they hit £210,000, if you are fortunate to deal with or have clients that are fortunate to be in that position, then your floor is hit at £10,000. Let's have a look at a quick example of that. If we have Bob here who earns £130,000 and he's got an employer pension contribution of £40,000, and we've assumed no carry forward just for the sake of this example, what would be the extra tax payable in this forthcoming tax year? So here's the adjusted income as we now need to look at it. The £130,000 plus the employer contribution gives us £170,000. That's the adjusted income figure. The excess over the 150 watershed is £20,000 obviously, and therefore the annual allowance is reduced by the £2 for every pound over that level. So we have a reduction to the annual allowance here of £10,000. Take the one from the other, your revised annual allowance for this particular client is now £30,000. The £10,000 is charged at the client's marginal rate, in this case £40,000, because obviously their current earnings is 130, and therefore we have to take a hit on that £10,000, so it's £4,000. Final little section just to look at, hopefully, sorry, I will go back just to let you digest that a moment, that's how the example will work, and again I would point you to some of the documentation that allows you to explore various other examples. And interestingly, there's been an update on the R08 manual that gives lots of examples for that as well. In terms of lifetime allowance, that is reducing from 1.25 down to 1 from the 6th of April with some transitional protection, which we're waiting to see how that's going to look as well. Lifetime allowance will be indexed from 6th of April 2018, but interesting enough, as we all know, CPR at the moment is bumping along at sort of ground zero, so we'll just have to watch that one, I guess. The final bit here in terms of the green paper, why they don't actually call it, make it green, I don't know, but it just sort of helps the coloration really. What does it say? What is he trying to look at? Apparently, it's been over a decade since the government last reviewed support of the tax system through pensions. There you go. Need to make sure that anything that is proposed is simple and transparent and allow some sort of personal responsibility. And to make sure that anything that's introduced, and heaven knows we've had a lot of complexity around pensions over recent times, to make sure it doesn't undermine the incentive to save and to build on the success of the auto-enrolment. And the system needs to be sustainable. Why? Because of these. This is an extract from the particular document itself, and the closure of the consultation is the 30th September, by the by. When you look at some of the figures that we've got going on here from the government itself, the £50 billion is the cost, including national insurance relief. Take that off, it's still costing the government £34 billion in tax relief, and of course, yes, you get your money back, or the government gets its money back, but not particularly in an equal basis at the moment, 13.1 billion. I'm guessing that the government would like to transfer or flip those two figures over, but we will see how that actually works out after the consultation closes. There is also a suggestion of moving to a sort of tax exempt or T basis, as it's called, where the top-up has from a government is suggested. Certainly it might be considered more transparent when there's a lot of question marks out of this, and to consider some sort of future tax implications. Will it achieve this? How might this look? If I can quote from the document itself, in the longer term, when the public finances have been fixed, there will be a trade-off between the tax relief citizens receive and the rates that they pay whenever they consider that to be the case, which is food for thought. Interestingly, the government has so far managed via lifetime allowance changes and annual allowance changes to project a saving in this particular area. Remember, because this is all about putting the public finances back in order as far as they're concerned, a saving of £6 billion, and that is that's a 2.8 in the document itself. So you can see the direction of travel for the government in this particular area. You'll be relieved to know that that's kind of it from me. Hopefully you've not found that too painful, but it's been a very useful recap of where we are in the world of pensions to date. As ever, we will see any changes, and I'll hand you back now.
Thank you, Jeremy. Just to reiterate, your CPD certificate and a copy of the slides will be sent to you this afternoon via email. We've received a few questions so far. The first is from Helen, who was asked, do partnership offer any R08 training days?
That's a very good question. We aren't currently offering any, but I will certainly take that back on your behalf, because clearly it's close to everybody's heart. And we've done training in other aspects of financial services, so thank you. I will take that one back on your behalf, Hannah. Thank you.
Fine. The next question is from Tony, who was asked, would the passing of the pension pot have any impact on the receiver's lifetime allowance?
If it's come from the initial beneficiary or the initial pension holder, then it should not actually impact on the receiving individual's lifetime allowance, from as far as I can remember. That's the case.
Okay, thank you. We haven't had any more questions as of yet, so we'll just give them a little bit more time to submit any questions.
Gosh, very shy and retiring.
Paul has just asked, can you confirm tapered annual allowance in 2016?
Yes, indeed. That's for those individuals that are going to have adjusted income over £150,000, and you need to look closely at that definition of the adjusted income, because there are two criteria to consider there: the £150,000 and also the net income figure of £110,000, and it's the interrelationship between those two that will impact on a tapering of annual allowance. So, as I say, for those people that are in receipt of pension contributions, by either they're doing them themselves or from an employer basis, contributions that reduce taxable income, so those things such as the net pay arrangement, or gosh, if you can find any sort of good old 226 policies. It doesn't include things like personal pension plans which benefit from relief at source, and they're not added in, as you've already had the tax included within the net income. So it's an interrelationship between the £110,000 and adjusted income for that. Hopefully that clarifies it a little bit for you.
Thank you. Question from Richard regarding switchers. Which safeguard rights require a pension specialist to advise?
That's a very good question. For switches, I'm not aware of needing a pension specialist to do so, but we can try and find an answer for you on that one, because I wouldn't be able to go any further than what I've just said there, really.
Okay. And a question from Michael: how does salary sacrifice affect contribution in 2016?
Well, again, it is my understanding that salary sacrifice will effectively mean that it'll be added back in to arrive at the adjusted income figure. Hopefully that's clear.
So we haven't any more questions.
Thank you for those questions, folks. It's really good to keep me on my toes.
If any of the members do have any questions, if you drop us an email, we can then forward them over to Partnership this afternoon. But thank you all for attending. And,
yes, indeed. Thanks, everybody.
Yeah, thank you.
Bye now. Bye-bye.